Thank you, Francois. And you've also given me a perfect opportunity to point out that we have a long and proud history, actually, on working alongside the private sector in support of responsible innovation that encourages efficiency, lowers costs, and brings better products to the public. We do favor responsible innovation, including in crypto-related services or products. I think back to the times when checks became obsolete in a lot of ways, and we were very much in the middle of fostering that transition. The Fed is also roughly a year away from rolling out FedNow, which is an instant payment system that will make instant real-time payments available to the public through their banks. So the whole point of regulation, of course, is to create a level playing field that will allow us to reap the benefits of true innovation while avoiding the pitfalls of regulatory evasion. So turning to regulation, I guess I'll make a couple of higher level points about the regulatory challenge that we all face, and then talk a little bit more about stablecoins, which I agree are to be thought of as quite different from unbacked crypto assets. So I guess the fundamental principle for all of us, is same risk, same regulation. Some of these crypto activities resemble traditional financial activities, and they need that. They need same risk, same regulation wherever they take place. There are also some novel activities, though, genuinely novel, that are really a paradigm shift. For example, replacing intermediaries with smart contracts or decentralized governance and control structures. And so these novel structures create potential new risks, and I think we have a lot of work to do on that. We've got a lot of work to do across both the more traditional looking parts of DeFi, but especially for the novel aspects of it. An example would be unhosted wallets, for example, which allow users to custody their own crypto assets. However, they can also be used to evade sanctions or engage in money laundering. And there are other novel aspects of it that are quite challenging. Not least, as I guess two of my colleagues have pointed out, the fact that this is a borderless world, and just we look to regulate an entity, and as I think Ravi pointed out, if that entity is an algorithm, how do we do that? So there's a lot of work and a lot of thinking to do to determine what practices are acceptable, which ones are flawed and predatory, what can be done to address these problems. This is new technology. It certainly has the possibility to bring improvements and efficiencies to the financial system. We've got to realize, though, that in some cases these apparent efficiencies are really superficial in the sense that the cost saving comes from ignoring risks or failing to maintain appropriate levels of assets and liquidity to deal with those risks in good time and bad, and from complying with laws. So those are some higher level points. On stablecoins in particular, so as I think others have pointed out, most of the usage of stablecoins now is on the crypto platforms. In effect, stablecoins are a money-like asset that is used to settle transactions on DeFi platforms. But many stablecoin issuers are talking about it, and there's a great deal of interest, I think, everywhere among potential stablecoin issuers to reach the general public more broadly, including retail payments and that sort of thing. And I think so. That's really what our main focus here from a regulatory standpoint is should stablecoins be used in that way, much more broadly, much more public facing, away from the crypto platforms? What's the appropriate regulatory structure? And we have a group of U.S. regulatory agencies under the leadership of the Treasury Department put together a proposal or an analysis and a proposal, and we encourage Congress to pass legislation, which we think is needed for this kind of stablecoins. I'm happy to say that the House Financial Services Committee here in the United States is working on a bipartisan bill. And that's a very constructive enterprise. I will say that from the standpoint of the Fed, the central bank, we think that the central bank is and will always be the main source of trust behind money. Stablecoins essentially borrow that trust from the underlying issuer, and in many cases, these are dollar stablecoins, so they're really borrowing that trust. These are private forms of money. They will be subject to runs if the reserves are not full of very high quality assets. So there's a regulatory job to be done there. We also think if you're going to have private money created across the country, really there needs to be a federal role. I would liken it to what happens with the dual banking system here, where there's a very important role for state regulators, but there's also a role for any commercial bank in the United States. There's also a role in licensing that bank to operate at the Fed or another federal agency. And in the case of this, which is money creation, we think it really should be the Fed that does play that role. So that's our principal focus now, I would say. Turning to your question, so cash is not disappearing here in the United States. We still use cash quite a lot. It is declining, not in absolute terms, but compared to non-cash payments, it's declining. And we're motivated by really what Christine was saying, to look very carefully at the potential costs and benefits of issuing a central bank digital currency here in the United States. So we agree that the central bank has always provided the stable, trusted anchor for the currency. That's really perhaps our most fundamental role as central banks, one of the most fundamental roles anyway. So we're looking at it very carefully. We're evaluating both the policy issues and the technology issues, and we're doing that with a very broad scope. We have not decided to proceed, and we don't see ourselves as making that decision for some time. We see ourselves as working in collaboration with both Congress, of course, but also with the executive branch, which brings expertise to many of the issues that we have to deal with here. And at the end of the day, we will need approval from both the executive branch and Congress to move ahead with a central bank digital currency. So we see this as a process of at least a couple of years where we're doing work and building public confidence in our analysis and in our ultimate conclusions, which, as I say, we certainly haven't reached yet. I guess I would just say that's where we are. We've got a lot of work to do. There are many more things to say, Francois, but I'll stop there.
Comments, in my view, about central bank money, trust, and stable coins were very enlightening. Do you allow me one further question, Jay? Listening to you, I was thinking that perhaps dollar-based stable coins are not that different from MMF, money market funds. Would you agree with this parallel? And could it mean that their regulation should not be that different from the regulation of MMF?
I think, Francois, that's a very reasonable observation. If you think about, and these are not the stable coins that are being used on the crypto platforms. This is a world in which stable coins are being offered more to the general public. So they have aspects of bank deposits. You could say they have aspects of money market funds, and of course, both of those are very substantially regulated, and appropriately so, because the general public will look at, I think we know from our experience over time, they'll look at a form of private money like that, and they'll assume that it's money, that it's money good, that it has the central bank's backing, or something like that, so that they can trust it. And we just need to make sure that if the public is going to be facing and dealing with stable coins that carry that implication, that the reality is there. And I guess Javier mentioned the reserves. The reserves need to be transparent, publicly transparent to the public, and they need to consist of the kind of credit assets that will always be there when there's a need to fund withdrawals, because otherwise the structure will be run-proof. And we saw that in the last few months in a couple of cases where stablecoins were not able to handle the withdrawals, and we saw it regularly with money market funds in the last two financial crises. In both of those cases, some of the money market funds were not able to, or really struggled to keep up, and the Fed had to step in and provide liquidity to that part of the market. So again, that's another form of private money, and we think it needs appropriate regulation. Francois, that we haven't made, as you know, decisions to proceed or not, but we issued a discussion paper in January of this year, and we said that we think that there are four characteristics of, if we were to pursue a CBDC, it would at a minimum have the following four characteristics. First is intermediated. Second is privacy protected. But third is identity verified. So it would not be anonymous. It would not be an anonymous bearer instrument. And fourth is transferable or interoperable. So we would be looking to balance privacy protection with identity verification, which has to be done, of course, in today's traditional banking system as well.
Thank you very much for this answer. Christine, sorry, you raised your hand. I didn't see it. Please.
Very briefly, Francois. Two things. One is when we surveyed Europeans, the first concern that they had, in addition to the support to the digital euro, was privacy. Privacy is first and foremost on their mind when we develop the digital euro. In terms of anonymity, there would not be complete anonymity as there is with banknotes, for instance, but there would be a limited level of disclosure, and certainly not at the central bank level.
Okay. Agustin or Ravi, nothing to add? So, if you agree, we will stop there to be on time.